Hello, everyone. Welcome. Thank you. Thank you so much for joining us today. We're going to start now, but before we begin the training, I really just want to take a few minutes to introduce the program and also to introduce you to our partners who will be bringing greetings today. Hope you're all hearing me clearly. So the webinar series, this particular webinar series is being made possible by the Big Up Small Business Project. And the Big Up Small Business Project is a joint initiative of TUI Care Foundation and the Travel Foundation. The project itself aims to create new opportunities for small, micro, and medium-sized entrepreneurs in Jamaica to benefit from tourism. Next slide, Rebecca. I'm Coral Williams, and I'm the Jamaica Program Coordinator for the Travel Foundation based here in Jamaica. Meet my colleague, Rebecca Armstrong. Rebecca is a Sustainable Tourism Specialist at the Travel Foundation, and Rebecca is based in the UK office in Bristol. Together, Rebecca and I are responsible for implementing the activities under the Big Up Small Business Project. And of course, both of us will be hosting today's session. Next slide. So these Business Basics webinar series that you're about to participate in are part of our capacity building support under the project, and they're being brought to you by the Travel Foundation in partnership with TPDCO. The training sessions today begin today, and they'll continue until the 3rd of November. They're really designed to develop the knowledge and the skills of you as small, micro, and medium-sized tourism entrepreneurs. They're designed to help you to efficiently manage and to grow your tourism businesses, to increase your earnings, and of course, to enhance your livelihoods. So the aim of these training sessions is to provide the basic tools and practical information to enable you to structure your business operations in an efficient and a financially viable way. So we hope that you'll be able to benefit from them in that way. Each week, as I said, we're starting today, continuing until the 3rd of November. Each week, the webinar will focus on a different topic. So today's training will be on Business Sense 101, and you'll learn how to structure your business as well as basic bookkeeping skills. Next week, Thursday, same place, same time, on the 13th of October, the topic will be on how to write business plans. And then on Thursday, the 20th of October, the training will focus on how to prepare to access funding. So you'll learn how to assess your business's financial needs and how to complete funding applications. On the 27th of October, we'll be looking at how to future-proof your business through energy and resource efficiency, and also benefiting your local community. And the final webinar will take place on Thursday, 3rd of November, and that will be on digital marketing. So you'll get tips on how to promote your tourism business and how to maximize your marketing. Of course, you're welcome to attend them all. At this time, I would like to introduce you to some special people from our partner organizations who will be saying a few words of greetings. Before I go ahead, Rebecca, is everyone here? Are they all here?
Jeremy is just joining, I think. So
okay.
And we'll be first. Thank you.
Okay, perfect. All right. Well, I'd like to welcome Jeremy Sampson. Jeremy is the Chief Executive Officer of the Travel Foundation. And I think Jeremy is based in our office in Bristol. I think he's there today. And also welcome to Manuel Ferreira. Manuel is the program manager at TUI Care Foundation. And Manuel is based in London in the UK as well. And of course, TUI Care Foundation funds the Big Up Small Business Project. We should be joined shortly by Mr. Wade Mars. He's the Executive Director of the Tourism Product Development Company Limited, TPD.
Wade Mars is here.
Oh, excellent. Welcome, Mr. Mars. Great. Now, TPDCO is partnering with the Travel Foundation to deliver some of the activities under the Big Up Small Business Project. In fact, TPDCO has been partnering with us since 2017, and our partnership is memorialized in a memorandum of understanding. So, you know, as we say in Jamaica, they're with us through thick and thin. All right, I'm not going to take up too much more of your time. I'd now like to invite Jeremy to bring welcome on behalf of the Travel Foundation.
Manuel is speaking first.
Manuel first, my bad. Manuel, please bring greetings on behalf of TUI Care Foundation.
No worries. Thank you so much, Coral, for the introduction. And hello, everyone. It's so great to see such a full house, 56 participants. It's always great to see. So I'm here representing, of course, the TUI Care Foundation, which you might have heard of TUI, either in buses or cruises or hotels that you can see around Jamaica. Yeah, TUI as the travel company, and the TUI Care Foundation is actually an independent charitable organization that was originally initiated by TUI. But we operate completely independently, and all our projects are striving towards positively impacting tourism destinations through the power of tourism, because we do believe that the tourism industry has such a great potential for positive impact. So our projects are mostly focused on enabling education for vulnerable communities, increasing the livelihoods and supporting entrepreneurship, which is why we are here as a primary project owner for the Bay Up Small Business Competition. And of course, also for anything concerning marine conservation, preservation of our landscapes is also a big topic for us. So that is basically what the TUI Care Foundation is all about. And for me, it's really exciting to be here today because I joined the TUI Care Foundation, I guess, 2.5 years ago. And my first project was actually a recovery package for businesses struggling with the effects of Corona, which I guess everyone who is in this room has been personally affected by the pandemic and is really either struggling or still fighting to grow to the volume of income of business that we were having before the pandemic. Some of you are also probably starting up your businesses in what is a really difficult context. So I really am excited that I saw in that project that I was initially with, which was the tourism recovery program, that in 5 different countries that we were working, the challenges were pretty much very similar. And I'm happy to see that the subjects that you're covering with these webinars are actually very, very close to the online training component that we had there. So all I can say is really enjoy the webinars. These are all very, very important topics. I love that digitalization and digital marketing is going to be the last topic, which I'm very excited about. I think it's a very essential topic, but in the end, all 5 webinars are. So it's very challenging, obviously, that, nowadays the new ways of working, everything is virtual over physical. So it's really important, and this is my advice to you, to really take whatever you can from these sessions and really be proactively listening to everything everyone is saying. I bet you'll get some amazing knowledge out of it. So thank you so much. Really a great pleasure for the TUI Care Foundation to be involved, and as always with the Travel Foundation, our partners. Yeah, thank you so much.
Thank you so much, Manuel. Thank you for that. Yes, it is our hope that everybody will actually take what they can get from these seminars, and as you know, they're free. So we're really hoping that you'll learn quite a bit, and then that you'll take that knowledge and transfer it to your business so that you can grow your businesses. Thanks again, Manuel. Jeremy will now bring us greetings from the Travel Foundation.
Thank you, Coral, and greetings to everybody. It's really nice to join you all for a few minutes and just to share some thoughts and welcome you all to today's webinar. So we're just absolutely delighted to be offering this further series of webinars to support small and medium tourism businesses in Jamaica. And I want to extend our gratitude as well to the TUI Care Foundation for their funding and support throughout this project, and for being a great partner over the years. The project is coming to an end in February 2023, and it's been quite a journey, this project, starting before COVID and what seems like a different world. And here we are sort of on the other end, having learned new things and become resilient in new ways, and wrapping up the program in the next couple of months, having adapted as we went along too. And I think that's been a really good lesson for all of us. I want to thank also TPDCO for their support. It's been really vital to work together to support the small and medium-sized enterprises, which make up the heart of the Jamaican tourism industry and make it so vibrant and diverse, and particularly again in the context of the challenges of the last few years. But you know, these businesses are indeed, you all are the ones who offer, you know, help Jamaica to offer a truly unique visitor experience. And we've been very happy to collaborate with TPDCO to help create the enabling environment needed for these enterprises to flourish and to grow. And we really just encourage you all to continue to do so, to continue to create that foundation. And it's true everywhere in the world that those destinations that have a beating heart, that are represented by local businesses, are really the ones that stand out in creating a better visitor economy and a sort of more equitable experience for all. I want to thank you specifically to all the businesses who have given up your valuable time to join us today, and to put trust in spending this time together with us over the next 5 weeks. We sincerely hope that the skills and the knowledge that these trainings will offer you will help equip you in your business and business operations on a day-to-day basis, and that you'll find both practical, practicality and inspiration from this, from this series of webinars. And we are delighted to be joined by specialist trainers from Jamaica for some of this series, with particular thanks to Anna Kay and Priscilla from Premium Consultancy Services, who will be running today's session. And with that, I'd like to wish you a wonderful session today, a wonderful series of webinars, and with lots of gratitude and hope that we will continue to collaborate long into the future. Thank you very much.
Thank you very much, Jeremy. Thank you so much. Yes, we were all raring to start, but before we do, we'd love to hear from Mr. Wade Mars, Executive Director at TPDCO. Mr. Mars, over to you.
Yes, good morning all. Good morning all. We at TPDCO, we too value the partnership that we've cultivated over the years with the Travel Foundation as well as TUI Care. And this program is very important to us in terms of building the capacity and the resilience of the small businesses within the tourism sector. It is, it is with some remorse that it's actually coming to an end. It would be good if we could find some way of doing other things in the near future, mutually beneficial to all, especially the tourism players and stakeholders, right? But that nonetheless, we would like to thank you, and we hope that the participants of today's session really use it to their long-term benefit, and it extends to the benefit of the entire industry. Thank you.
Thank you very much, Mr. Mars and Jeremy and Manuel, for your warm words of welcome and encouragement. Yeah, just for me, it's great to have the opportunity to collaborate through the Big Up Small Business programme. As Coral mentioned, we're just about to get started on the first of these 5 webinars. I'm delighted that Anna Kay Wilson and Priscilla Spence-Wisdom from Premium Consultancy Services are with us today. They will be taking us through our first 2 topics, actually 2 in 1 today. So Anna Kay will be focusing on business structures. After that, we'll have a short time for question and answers. And then Priscilla will be focusing on basic bookkeeping skills for tourism businesses. And again, after that presentation, we'll have an opportunity for questions. So please do use the question and answer box, which you should see on your Zoom controls, for any questions that you'd like to put to the speakers as they're speaking. Anything that comes to mind, please do put your questions in there, and then at the end of each presentation, Coral and I will moderate those questions and put them to Anna Kay and Priscilla. Any other queries or comments, please do pop them in the chat. but if you use the question and answer function, we'll be able to see your questions there easily. Just one more thing to say is that this series is also going to be supplemented by some toolkits to go with each topic. So those will be made available after the sessions as well. So I'm really pleased to hand over now to Anna Kay, if you'd like to share your screen. Anna Kay, thank you very much.
Good morning, everyone. I thank you, Rebecca, for the introduction. And as we go through today on how to structure your business, I'm assuming that some of you participants would have already registered your business or you're planning to do so. And so at the end of this session, you should have some understanding as to how to proceed in registering your business, or if you're already registered, you would know how to operate in that realm or to change that business structure if you so desire. So our learning outcome for today, is to know the various key business structures and how to determine the structure that suits your needs, to know how to organize your business structure and understand the basic requirements of managing same, and to know the various tax requirements based on your chosen legal structure and how to maintain tax compliance. Legal structure. So when we speak of legal structure, we're referring to a company or a business. When we speak of a business, when you speak of a company, let's do that first. A company is pretty much a commercial enterprise that is registered or incorporated under the Companies Act of Jamaica. That is, a company can either be a non-profit, which is a charity organization, a club, or a profit-generating entity. Most of the entities that are on today, I'm presuming, are profit-generating. The Travel Foundation and TOEIC Care Foundation, they would be a non-profit organization. Business is also a legal structure, however, that can be a sole trader or a partnership, which is registered under the Business Name Act in Jamaica. We'll be looking at the business name. And when we speak of business name, we're looking at sole trader and partnership. Legal structure as it relates to business names. So business names are registered with the Companies Office of Jamaica. You are required to register with them. So if you do operate using a particular name and you're not registered with the Companies Office of Jamaica, then you are pretty much operating illegally. Once you are registered with the Companies Office of Jamaica, your information is now registered on a public record. So anyone may go to the Companies Office of Jamaica, or even go on their website and search for your business name, and they're able to find some basic information that will guide them as to who or where the registered office is located and the main person who is responsible for this entity. If it's a company, then they'll see the company secretary's name. For sole trader, though, they don't normally see the person's name unless they go in and make further inquiries. When they check online, they don't see the registered location. But pretty much once you're registered with the Companies Office of Jamaica, your information is now public record. So who should register a business name? Any individual or firm buying or selling goods from an established address. Any individual or firm offering services from an established address in a name other than its or their own name. The following persons need not register a business name, and that is persons who buy or sell livestock, persons who occupy public market stalls and pay market fees, firms established for social or welfare purposes, public service, religion, charity, education, and whose income and profits are used solely for that purpose. However, the previous slide indicated that if you are operating one name other than your given name, so my name is Anna K. Wilson, as you have heard. If I operate a business in my name, Anna K. Wilson, I am not required to register a business name because I am operating in my given name. However, if I decide to operate a business and have a unique name, so my entity is called Premium Consultancy Services Limited. That entity's name must be registered with the Companies Office of Jamaica because I'm now operating under a different name versus my given name, Anna K. Wilson. All right. So in that sense, you must register even if you are a person who buy and sell livestock. If you have decided to step away from your given name and decide to create a unique name, then you are now required to register that name and operate accordingly. As a sole trader, one individual runs and owns the entire business. You are pretty much the business. The individual and the owner, they are one. So the advantages of that is that you reap all the rewards and benefits of being a sole trader. Your freedom to make all decisions. Sole trader do not have to disclose accounts to Companies Office of Jamaica, and later on, you will have an idea as to what it means to disclose information or disclose accounts. And as a sole trader, that entity is easy to dissolve if you so desire to close operation. The drawback to being a sole trader is that you are taking on all the risk of the business. You have unlimited responsibilities. It means all personal asset at risk for any debt, and the sole trader runs the risk of bankruptcy. As a sole trader, as was mentioned before, you are the business. Even though you may have a business name, in legal sense, you are not separated from the business. And so if there is an instance of any legal matters, you are the one being sued, not necessarily the business itself. And so in setting up your operations, that is something that you will have to be mindful of, that you are not separate from the business. And in the case of any legal matters that may arise as a result of operating, and if you are then required to make any payment because of a situation that may happen at your premises or due to your business conduct, then your own personal income may be affected depending on the fundings that would have been available in your sole trader business. Another aspect of a business name registration is a partnership. A partnership, this is pretty much 2 or more persons, up to a maximum of 20 persons, working together to do a trade or business. It is important to have a partnership agreement in place because this dictates or this guides the partnership as to how to operate, who is responsible for what, how are the profit and the losses are going to be shared among the partners. The partnership agreement tells all of that. Who is the main person who is responsible? Do we have one managing partner or do we have 2? So the agreement pretty much outlines how we operate in this relationship. The advantages of being a partnership is that there's shared risk and responsibilities. When you're a sole trader, you are the only person who will have to be making decisions. Now as a partnership, you have someone else to assist in this decision-making process. And you now have more than one experiences coming together to run this operation. All costs are shared in a partnership. So everything is shared, and the sharing is based on what is outlined in the partnership agreement. So the partnership agreement may say, okay, one partner will get 60%, another will get 40, or 50-50, or 30-70. So it depends, and it's best to outline this from the onset so that as the business operates, it will be able to know, each person will know who is responsible for what. The disadvantages, however, is that they have limited freedom to make decisions. And this is so because now you have to consult with someone when you're making a decision, versus if you're a sole trader, you decide what to do and you move along. If you're a partnership, you will have to meet, discuss, and decide on the way forward. Partners are jointly and individually liable for the actions of the other partners. So whereas in a sole trader, you would be responsible for your own actions, as a partnership, each partner, whatever another partner does, it affects the business and it affects you as well. And so it's best to know who you're going into partnership with, have an understanding of who this person is and their business relationship, how they handle certain matters. And truthfully, you may not know how persons behave until you're in this arrangement and the situation happens. But at least you will have some idea as to who this person is before you go into partnership with them. And I alluded to the fact earlier that there will be longer decision making because now you have another person to consult with, and so it may take a longer time to make a decision. We're going to now look at a limited company. And if you have any questions, please share, and Coral will address those, will bring those forward. Limited companies. So there are two main types of registered companies. We have limited by shares and limited by guarantees. Now I'm going to look at limited by shares first. And this is the common one that is used because it is used for profit-making ventures, and most entities that are registered, they are registered to make a profit, apart from the charitable organizations, as was shown before. So limited by shares, it means members can only lose the amount agreed to contribute for shares. So based on the onset of setting up this limited company, each members will decide how much funds they will put forward in running this operation. So one may have 100,000, another may have 50,000, and so forth, right? If something should go wrong, the word limited there means that each members will only be affected by the amount of shares that they contributed, the share value that they contributed in that entity. So the person with 100,000, for example, then whatever matter may come up later down in the business, if any legal issues, then if the company is required to pay out anything and there's not sufficient funds available in the company, and now the members will have to be involved in paying out this liability, that member would only be required to pay out as much as the amount that they would have contributed initially. Let me pause. I think I saw a question. Coral, do we take
We
the
will
question?
take the questions at the end of your presentation.
Okay, great. So limited by guarantee. Members agree based on the articles of incorporation. So when you're setting up the entity, there are some documents that needs to be completed. there is an article of incorporation, and this outlines for both limited by shares and limited by guarantee, there's an article of incorporation that would need to be completed. Once those are completed, it outlines how each or the company would operate based on the various articles that they would have assigned. And so in this limited by guarantee, they would have outlined that this person would contribute a fixed amount based on winding up. And that means when it says winding up, meaning the company is closing down. And the amount is actually specified in the article as to how much this member has agreed to put up. Usually non-profit making organizations are registered as a limited by guarantee. Limited by guarantee without share capital do not have share capital and shareholders. They just have members or trustees. So to give you some more information as to what a company is a legal body in its own right and existence that is separate in law from its owner. So whereas as a sole trader, the business and the owner, they are one entity. If you register a limited company, the owner and the company are separate legal bodies. And so if any actions are to be taken against the company, it is limited to the company. They are governed by the Companies Act of Jamaica, and so their actions are guided according to that act. There are some advantages and disadvantages. The advantages is that they have a limited liability. They're only liable for the amount outstanding on shares or guarantee, as was mentioned before. As a limited liability, it shows that there is perpetual succession, because if the members die, the company can keep going on. Whereas if you're a sole trader, if you die, the business die with you. If you are a partnership, then if one of the partner die, if it's two partners are in that partnership, if one partner dies, then you're no longer a partnership and you're now required to make adjustments to your initial registration that would have been done with Companies Office of Jamaica. But as a limited entity, you would have registered your company. Some companies can be registered with one director or one shareholder, but it must have a company secretary. But in any instance, if the director dies, then the business can go on based on the requirements that they would have had to meet when setting up that company. Company may sue and be sued in its own name, as was mentioned before. The company is separate from the league, from the owners, and so they are required, if any actions are taken against the company, it's limited to the company. The owners are not being sued unless it depends on the circumstances surrounding the matter before the court. Then at this moment, in the general sense, the actions are against the company and not against the directors / shareholders. The disadvantages of being a limited entity is that there are government regulations to adhere to. You are under more scrutiny, you're a public entity, and being registered with the Companies Office of Jamaica, the records are public. Anybody can go to their website or into their office, make a payment, and they're able to get all information that would have been filed with them on your company. They would know who the directors are, where the registered address is, and if they have filed all their requirements with them. As a limited entity, you have to disclose accounts to the Companies Office of Jamaica. That's a disadvantage. As sole traders and partnership, they do not have that requirement to disclose any accounts to Companies Office of Jamaica. As a limited entity, any changes you make in your management structure, your executive structure, that is. So if you change a director, that would need to be notified with the Companies Office of Jamaica. If you change your business address, you will need to notify the Companies Office of Jamaica. If you change your company secretary, you will need to notify the Companies Office of Jamaica. Any change that you make that was previously disclosed to the Companies Office of Jamaica, you will need to notify them subsequently. And there's a fee to this. Each time an adjustment is made, there is a charge for this. There is also an annual requirement for companies to file an annual return, which is separate and apart from your tax returns. So being a limited company, it has more administration burden to manage your company. You have to think of managing the company as well as meeting these requirements set out by the Companies Office of Jamaica and other government entities. So organizing and managing your business structure. We have touched on sole trader, partnership, and limited company. Now, one would need to determine which of these options are best for you. Based on your operation, is it feasible to have a sole trader business for now, and you can later transition to a limited company? For sole traders, the business name registration is valid for 3 years. After the 3 years, you have to renew that business name. At the renewal stage, you are able to transition from a sole trader to a limited company. You can even transition before the 3 years expire. So you can do this at any point in time. You can transition from sole trader to limited, from sole trader to partnership, or from partnership to limited company based on your given need. Because as you started out, things can change. You can have new insight as to how to operate, and you can change your legal structure. However, everything would have a cost associated with it. It's much cheaper to register as a sole trader and as a partnership. As a limited company, there are more costs to it with the Companies Office of Jamaica. Currently, the cost to register your sole trader business or your partnership is $2,500. For a limited company, the cost is about $24,500 up, and it depends. It may go up a little based on the number of pages that would be a part of your articles of incorporation. Because to print that document, they charge per page. And so it depends on the number of pages, then that $24,500 may be increased. That's Jamaican dollars. Taking the third step to register your business or transition from one business structure to the next. So at the end of this presentation, based on the advantages and the disadvantages that were disclosed, and also the manual that will be shared with you thereafter, it will outline in more details the more advantages and disadvantages that you can look at and to see, am I operating in the right business structure? Should I remain as a sole trader, or should I transition to a limited company? That's something that you should think about as you proceed. In managing your business structure, we are going to look at how you can plan for success, how you can build a team, maintain proper records, and know your taxes and your obligations. Oftentimes, entities register their companies or business name or partnership, and there are some basic information that they are not aware of, And so this section of the presentation will give you some basic understanding as to what is required of you and how you operate as a business. In the tax realm, ignorance is no excuse. And so not knowing what to do, it doesn't mean that you are not obligated to do it. And so you may find that you may incur penalties or some fines because you did not adhere or did not comply to what is required of you as a business or company. So planning for success, it would mean to develop a business plan. And thankfully, next week, there is a session for you that will outline in details how to do your business plan. The business plan, however, usually outlines your specific objectives of the business or company. It outlines some strategies that you would employ in the business, your finances, where you will get your finances in operating. It outlines your sales and marketing goals and a determination of the cash you need to get things done. So the business plan is critical at the onset. However, it's not too late if you didn't create one. You can do this as time progresses, because even if you had prepared one, as your business continues, you may need to change things in this document. It is not a static document. You update it as you go along so that it suits the current market conditions. And so it's best to write it down at the first step, at the onset, but it is not the end of it all if you haven't done that. You can do this as you go along. A lot of times we go into business and we have an idea. It's in our mind what we want to do and how we would want to progress. But when we start to write, sometimes things get a little bit clearer as to how we move forward. And so it's best to have it penned your ideas. And as when you see things in black and white, it gives you a better view, a better handle as to how to approach this situation. Building a team is another critical aspect of it. As a sole trader, you tend to do everything yourself. You hire, you are the marketing manager, you are the sales director, you are everybody in one. As limited companies, you may hire persons to do specific tasks, but either options, any legal structure that you have, is best to hire the right talent. And hire here doesn't mean employee-employer relationship. It may even mean a contractor. But have someone on your team that would share your goals, your plans for your organization, because it's good when you can have someone on board to help you in pushing the business forward. Empower your team to make decisions. Now, in hiring the right talent, you should now empower them to make decisions. And by empowering, it means that you will clearly outline your objectives, clearly outline your plans for your organization. Ensure that everyone is on par with what you as a company or as a business, where you want to be and how you move forward in getting there. In empowering your team, you identify also the skills that you lack, and also how best the person that you would have hired would be able to fit or to do these various areas that you are not so versed in. As a sole trader, you may not know much about accounting. You may not know much about legal matters, so you may need a lawyer. You may not know much about marketing. You can learn the basics, but if you so desire and if the resources are available, you can hire these persons. Invest in people and processes. By investing in people, you would have gone through the steps in hiring your right talent. So that would be a good start. But processes are important. processes are pretty much documenting your business procedures and your process of doing certain things. And these are, what are your processes in service delivery? What are your processes in sales and promotions? What are your processes in inventory management processes? And that's for those of you who would sell items. What is your process for record management? What is your process for accounting and tax filing? All of those things, it's best to write it down so that when you hire the right people, these documents would be available to them to use. And that you as the individual, in the aspect of a sole trader, you will not be so involved in all of these other process that, well, not process, functions that you have hired person to do, because you would have documented all these processes, and this document will now be available to them to see what the business intentions are and how you want it to be fulfilled, or guidelines as to how you want it to be fulfilled. This area of processes goes into the other aspect, which is to manage or maintain proper records. In maintaining proper records, you have to have, you're encouraged to create written records of everything. Everything, whatever you do, it must be recorded for business purposes. Reason being, one of the main issues that I find is that in the event of an audit with the tax authorities, for example, when their tax returns are filed, there's not much documentation to prove their expenses that they claimed on their tax returns. And so you find that the tax authority has nothing to substantiate why you said that your expenses were 100,000. You put on the tax return, your expenses are 100,000. Okay, fine. What are your proof? Where can I go to see this document or these documents? And that will mean your receipts, any expenses you incurred, and a business related expense. Let me be more clear. Business expenses, not your personal expenses. As such, for example, as a sole trader, you will incur a lot of expenses for your business and for yourself. If you go to the supermarket, that's not a business expense, so that expense should not be included on your tax return. And so that cannot be claimed on your tax return. And in the event that it is, then that's an error and it should be adjusted. Maintaining proper records is critical, is very critical. And so there was an instance where, there are numerous instances where the authority does audit, and they had requested some documentations of persons, and there was no proof of expense, and the person may have just simply put down a figure because they suspect that they would have incurred this amount of expense, but they don't have any documentation to prove it. They don't have the physical document. They don't have any bank statement to prove that they had actually incurred this expense, nothing. And so the onus is on you, the individual, the owner, or in a limited company standpoint, if you are hired as the accounting person, as an employee in that company, you should ensure that proper record keeping is in place, because these documents are critical. It's also good to maintain an accounting system. As a sole trader, you may not be able to have a computerized accounting system, and so some persons use Excel. Excel is good. I'm not bashing Excel. However, it's good to have a complete accounting system, because that helps to translate data into useful information. when you have an Excel document, you're putting in your expenses that you incur on a daily or monthly basis. And so you're just seeing what you spent, right? Versus if you were to use an accounting system and you enter those expenses, you're able to pull various reports to see, okay, where am I spending my money the most? Or you could say, okay, what is the highest amount that I've spent on a particular, or the highest amount that I've spent with a particular supplier. So you're able to pull reports from accounting system. If you just have a standard Excel file where you just enter that information, there's not much reporting can be pulled from that document. So it is encouraged a lot of accounting systems, free and also paid ones, that you can utilize to maintain. And Priscilla will shed some more light on what is, accounting and how to get this done. So this other section is very critical, knowing your taxes and your obligations, because you do not want to be in operation and you are not so clear as to how to move forward. And then you find yourself being drawn to court or being asked to pay some lump sum at some unforeseen times. So you would want to be on top of your game as to know what is required of you and when these taxes or obligations are due. As a sole trader, the business net profit is taxed on the owner. Says one tax return is filed as a sole trader. You would have done up your income statement, and your income statement is a document that shows your net income or your net profit, sorry, your net loss. All right. And so once that document is done, whatever the net profit or the loss is, you would now need to use that information to prepare your tax return. One of the drawbacks of being a sole trader is that if you file your tax return, you are required to disclose all your income. And when I say all your income, all your worldwide income. So you may have one business here, you may be in receipt of dividend income, you may be in receipt of interest income, you may also do some other services outside of the registered entity. And once tax return season has arrived, then you now have to accumulate or amalgamate all your income that you would have earned from all sources and include that on your tax return. However, you benefit from the annual tax-free threshold of the 1.5 million. And so that helps to reduce the amount of tax you pay at the end of the year. Another thing that I encourage persons to do as a sole trader, or even in companies, once you're filing your taxes, once you are aware of the tax deductions that you are able to claim, utilize it. Currently, payment to approved pension scheme, those will reduce your income tax. And I stress on income tax in particular, because the approved pension contribution that is deducted before your income tax is calculated, sorry. So once the tax-free threshold is deducted from your net profit, you calculate the respective taxes. However, if you have contributed to an approved pension plan, then whatever you paid, if you paid 60,000, 100,000, whatever you paid to that approved pension scheme, it is used as a deduction on your tax return. If you contribute to a charitable organization, an approved charitable organization, you are able to get a tax deduction for that as well. Not just as a sole trader, companies can get it as well. So it's just an approved tax deduction. So it's good to know what those tax deductions are, and you are able to get those deductions to reduce your tax liability. As a sole trader, as was mentioned, you have annual tax return filings. Those forms are called the SO4, which is the self-employed person annual returns of income taxes and contribution payable. That's what is SO4. And then SO4A, that is used to declare your estimated income taxes and contributions payable for the following year. So the SO4 is the current year tax return, and the SO4A is the estimate for the following year. We are currently in the year 2022. The tax return for the year 2022 is due March 15, 2023. When you're filing your return on March 15, 2023 next year, for the year 2022, you are also required to file a declaration of estimated income taxes and contribution payable for the year 2023. It's an estimate, and usually it is the same information that was used to prepare your SO4. It is used to prepare the SO4A. If you have employees as a sole trader, you should register for the relevant payroll tax account, which based on the current arrangement with Companies Office of Jamaica, once you have registered as a sole trader business, you are automatically registered with NIS, NHT, and HART. So if you have subsequently have persons that you employed to do various tasks for you, then you should deduct and pay over PAYE, NIS, NHT, and HART where applicable. Not all persons are required to pay PAYE, only those persons who are earning above the tax-free threshold, which is the 1.5 million. All right, and if they are minimum wage, or there I missed something from this, there's education tax as well. So PAYE, NIS, NHT, education tax, and HART that are applicable to be deducted on a monthly basis. As an employer, you are also required to file an annual return, which is separate from your self-employment return. It goes further. If your total gross sales, not a net sales now, your gross sales, if it is equal to or greater than 10 million, you are now required to register for GCT and file your monthly GCT return. Now, the government takes the GCT return very seriously. And so if you are registered for GCT and you collect this GCT, you must file and pay same over to the government. The good thing about it is that it's not what you may not pay over all that you have collected, because you are able to take as a deduction any GCT and any, in quotes, any GCT that you would have incurred in carrying out your business. So let me give a simple example. If you had a sale which had a GCT being collected of 100,000, and in carrying out your regular operations and you're buying goods and payment for services, in total for that month, you pay GCT to those persons for 50,000. The only amount that you will pay over to the government is a net of the tax that you collected and the tax that you paid, the GCT that you paid, and that would be 50,000. You collected 100,000 in tax, in GCT, and you paid 50,000 in GCT, the net of that is paid over to the government on a monthly basis. So we're moving forward to partnership. Partnership, some of the requirement that was shared in Sole Trader is valid for all business structure. However, there are certain requirements, there are other things that needs to be considered. For a partnership, the business net profit or loss is shared among the partners. They too have an annual return deadline of March 15th. Each partner is required to file a tax return based on their share of the profit or loss. Each partner can benefit from the tax-free threshold, and the partnership itself is required to file a return, but there's no tax payment. It's just to declare to the authority that the partnership made this amount of profit or loss, and it is shared among the partners, and those will be outlined on the tax return. So for a partnership, if it's 2 partners, then it's 3 returns are filed, 1 for each partner and 1 for the partnership itself. Versus if it's a sole trader, it's just 1 tax return is filed. So as a partnership, as I mentioned, you file your partnership return, which is the ITO3 form. Each partner should file their own SO4A and SO4 forms, and the information that is disclosed on those forms will be based on the share of profit from the partnership and any other income that they earn. They too, if the partnership has employee, then they will also be required to do the relevant payroll taxes and to pay that amount on a monthly basis and to file the annual tax return. If the sales are also greater than 10 million, they are also required to register for GCT. Currently, we have 2 main rates. We have 15% and 10%. The 10% is mainly used for those in the tourism industry like hotels. Their tax rates 10% based on their hotel services, the accommodation services that they would have provided. But the standard GCT rate is 15%. For a limited company, it's a little bit different because their net profit or loss is taxed on the company. So for sole trader, the tax return, the individual, the owner, files the tax return using their TRN. For the partnership, 3 returns are filed, 1 for the partnership with the partnership's own TRN, and then each partner would file their own individual tax return on their TRN. As a limited entity, they would also have their own TRN, and they will now be required to file an annual tax return with the tax authorities. They have the same deadline as well, March 15th. However, as a limited company, you are only able to get a corporate tax credit of $375,000, and there is a limit if your annual revenue is 5 million or less. If your annual revenue, which is your annual sales, is 5 million or less, you are able to get a tax credit of $375,000. So if your tax liability work out to be less than this 375, it simply means that there's no tax to pay for that year. You just file the return and apply the credit to clear your tax liability. There's 2 tax rates. We have 25% for unregulated and 33 1/3 for regulated. And regulated here just simply means that those entities that are regulated or managed are overseen by the financial institutions, Regulated entities include financial institutions, security dealers, general insurance companies, utility companies, and telecommunication companies. And they would be regulated by the Bank of Jamaica or the Financial Services Commission, the Ministry of Finance and Planning, and or the Office of the Youth. They too file their annual return, same deadline, March 15th. Same thing would apply to them if they have employees, they need to deduct and pay those funds to the tax authority and also file their annual return. If their gross sale is greater than the equal or greater than 10 million, they too would need to be required to register for GCT. Each director, they should file their own SO4, SO4A. I put an asterisk there because if that person, if that director only have that specific company and they are also an employee in that company and that income is already being taxed and they have no other source of income, there's not a requirement for them to file a self-employed return. And other requirement for companies is that they have to file annual return with the Companies Office of Jamaica. Right, they have to file an annual return with the Companies Office of Jamaica, and any other changes that they would have made to their records, they would need to file that with the Companies Office of Jamaica. And I touched on it earlier in relation to if they change the company secretary, they would need to file a return. A return, quote unquote, it's really a form that is completed and shared with the Companies Office of Jamaica. And there are specific forms based on the type of changes that are done. Those are filed with the Companies Office of Jamaica. For charities organizations, they do not file tax return. However, they have filing obligations with the Department of Cooperative and Friendly Society, and their deadline is March 31st. So just in case we have any charitable organizations online, apart from the Chamber Foundation and TUI, once you're registered here in Jamaica, that is, your requirement is to do an annual filing with the Department of Cooperative and Friendly Society. You have other requirements if you are in the accommodation business. So you have the GART, which is the guest accommodation room tax. And so this is levied on the number of guests that are occupied. There is a standard listing that the tax authority have on their website, which outlines the fee that is required based on the number of rooms that you provide. The tax returns are due on the last day of the month, the last business day, that is, of the month. Organizations who are in the tourism industry are required to be in possession of a tourist board license. There are 13 categories with varied requirements, and you should make yourself familiar with those requirements so that you can be in compliance with the Tourist Board Act. This has brought us to the end of this part of my presentation. Thereafter, you'll have Priscilla Spence with bookkeeping. So I am ready to answer all your questions that I know you have. Coral.
Yeah, thank you so much, Anna Kay, for that. We have quite a few questions and not much time, but I'll try to get through them. The first one I see here is, if a nonprofit organization is registered under the cooperative societies and friendly societies, is that considered acceptable or legally registered?
Yes, Yes, you are a legal registered entity as the DCFS. They have that mandate to register charitable organizations, and so they are reputable. They are a government entity, and so you are required to register with them, and that would mean that you are a legal entity.
Great, thanks. The second question is, my business doesn't have a physical location. I want to register next month, but will I have to get a physical office, or is it okay to go ahead and register my tour business?
Okay, you need not to have a physical location to register a business. What usually happens if you're registered as a sole trader, it's your address, whichever address you put as your registered address, that could be your home address, then that address would be on record as your registered address, and you can operate virtually.
Okay, good. I think these next two questions are pretty much similar. They're asking you to give examples of the free account and records keeping program that can be used on your computer outside of Excel.
Okay, so currently there is Wave app. It's Wave app, and they offer free accounting service. There is another one that is called, well, QuickBooks have a limited free version. You could try that out, but they give you 1 month access. Thereafter, you make a payment. There is also Xero, which is spelled with an X. And there's another one which is called Freebook that you can utilize. Some of these, they give you maybe 30 days free or 7 days free, but Wave in particular is 100% free. However, they are soon to move away from offering the service to international market because they are located in Canada. And so they are looking to limit the services that they provide to international markets.
Okay. And then this next question says, if you hire occasional freelancers or persons on an ad hoc basis, I guess, and I've lost it. I think they're asking if they will need to file deductions for those persons as employees.
No. Once those persons are established as a contract for service, so this is what you will need to know. If you contract for service, then there's no employee-employer relationship. So it means that once there's no employee-employer relationship, there's no requirement to deduct any payroll taxes and file over.
Okay. I think that may come into with the latest ruling with the security companies. Maybe that's becoming a topical issue as well. Sorry, Karen. The next question is, does the limited liability have its own TRN that differs from the owner's TRN?
Yes, it does.
Okay.
Separate TRN.
Great. And then there's another question that asks for you to clarify the tax obligations for directors in a limited company with regards to filing of personal SOA and SO4, sorry, and SO4A.
Okay, so as a director in a company, if you are employed in that same company and taxes are being deducted from that salary that you are being paid by the company, then you may not be required to file a tax return if you do not have any other sources of income. If your only source of income is from that company alone that you are a director of, and you are paying yourself a salary and deducting the relevant payroll taxes, then there's no requirement to file a separate tax return as a director.
Okay. There was a question here that asks 5 million or 500 million. I think that's regarding some threshold that you mentioned.
Yes, to get the tax credit, it's 500.
500 million?
Yes.
Okay. And then another question, this one is relating to software, which you've already answered. I know there's another one that's asking, when you say donating to approved charities, does this include social enterprise?
Well, there is an approved listing. So if that entity is not a part of that listing, whether or not they are social enterprise, then it would not be considered as an approved donation. You may not be able to get that as a
Deduction.
donation, as a tax deduction. You can't classify it as a donation to an approved charitable organization. There's a standard listing which can be found on the Tax Administration of Jamaica's website. And if that entity is not on that listing, then that deduction cannot be treated as a donation to an approved charitable organization.
Okay. And then here's one that says that they filed their taxes for less than 300,000, and in both years they were asked to pay tax. Why was this so?
So are you registered as a sole trader or companies or a limited company? If you are registered as a limited company and your net profit is less than the 375,000 the tax credit that is available to you, then there will be no tax. If you are a sole trader and if you earn less than the tax-free threshold, then there's no income tax. However, you will have NIS and other tax type. So income tax is not the only tax that you should be mindful of. There's NIS, education tax, NHT, to be paid by an individual. So it depends on your circumstance there. I'm not so sure, but if your net profit was 300,000, you may not have any income tax, but you would have had NIS, NHT, and ed tax to pay.
Okay. And what is the percentage breakdown of taxes for self-employed persons?
Okay, so for self-employed persons, you have for NIS is 6%, NHT 3%, education tax 2.25%, and income tax, if your earnings are greater than the tax-free threshold, then it's 25%. Maximum, if you're earning to a maximum of 6 million, is 25. If your earning is greater than 6 million, it's 30%.
Okay. The person who asked about the 300,000 taxes that they're being asked to pay deductions for, I think they just clarified to say that they're registered as a partnership.
So the 300,000 as a partner, the partnership itself doesn't pay taxes. So if that 300,000 is shared among the partners, then based on the individual's total earnings for that particular year, less their tax-free threshold, they wouldn't have income tax to pay, but they may have NIS, education tax, and NHT to pay.
Okay, great. Thanks so much, Anna Kay. I think that was quite informative, and I'm hoping that you all found it informative and educational. We're going to move on to the second session now. And that second session is on bookkeeping skills that will be presented by Priscilla Spence Wisdom. Priscilla is a certified fraud examiner and a chartered certified accountant. She's currently the company secretary at Premium Consultancy Services Limited, and she's the SOX manager at one of Jamaica's largest communications providers. Priscilla has over 10 years audit and accounting experience, which spans many industries. Welcome, Priscilla. Over to you.
Thank you, Rebecca. Good. Sorry. Thank you, Coral. I was talking to Rebecca in the chat. Sorry.
Okay.
Hi, good morning still. So good morning, everyone. As was indicated, I'm Priscilla Spence Wisdom, and my presentation will be on accounting and bookkeeping skills. Please indicate that you're able to see my screen.
Yes, we can. Thank you.
You are welcome. Let me just. All right. So in this session, we will be covering, as the title suggests, basic bookkeeping skills, right? And there is no way I could teach a full accounting session in even a month. We'd need at least a couple years, right? So in our outline this morning, we will be going through mainly 3 areas. We'll be looking at some key accounting terms, we'll be looking at some basic bookkeeping skills, and then I'll just provide you with some tips on maintaining proper accounting records. Just want to make sure that none of my presentation is blocked out. All right. So the first thing somebody usually asks is, what is accounting or what is bookkeeping? Right now, accounting, and this is the book definition, is the identification. So you have to identify, you have to accumulate, meaning put together, and you have to measure, right, and communicate data about an entity. So accounting is the identification, the accumulation, the measurement, and communication of economic data about an enterprise for decision makers and other interested parties. And we say other interested parties because there are many users of financial statements, and each of those users have a different purpose for using the financial statements, right? So just to reiterate, for accounting, you identify, you accumulate, you measure, meaning assign a value, and you communicate economic data. And when it says economic data, it means money about an enterprise for decision makers. Now, bookkeeping is the activity or the occupation of keeping financial records, keeping records of the financial affairs of a business. Bookkeeping is the foundation or the base of accounting. Now, bookkeeping, and some people may be wondering, but I thought, or they may be saying to themselves, but I thought they were the same thing. In fact, they aren't. The accountant or accounting, they use information from bookkeeping to prepare financial reports. So I don't know how many of you still buy the hard copy Observer or the hard copy Gleaner. You will see where listed companies such as a Fontana or a Bank of Nova Scotia, they would prepare their financial statements and publish it. Now, the accountant that prepares that financial statements, they use the information from the bookkeeping to present those in a meaningful way, right? And bookkeeping is just one segment of the whole accounting system. So we take, for instance, if you buy a car for the business, the bookkeeper is the one that, bookkeeping is the act of physically putting that in your reporting system. Now, if you buy 10 cars, the accountant would accumulate all of those entries by the bookkeeper, and then they will report it in a meaningful way. So that is the major difference, right? Now, let us look at some key accounting terms. For key accounting terms, we'll be looking at general terms, we'll be looking at balance sheet terms, and I'll tell you what these are. We'll be looking at income statement terms, right? So some general accounting terms, you will hear somebody say accounting period, or you will hear somebody say reporting year, or you will hear somebody say, what is your year-end date? Right, so the accounting period is the length of time covered by a financial statement or an operation, right? While allocation is the procedure of assigning funds to various accounts or period. For example, a cost can be allocated over multiple months or over multiple departments for larger businesses, right? You will also hear the term cash flow. So that is defined as the inflow or outflow of cash in a business, right? So some businesses, they are very cash focused. So most of their transactions are with cash. And then there are some businesses who also have huge cash balances, right? Now, cash flow is the inflow or the outflow, money coming in, money going out. Now, a business or legal entity, and Annika would have gone through that in detail previously, is a legal structure or type of a business, right? Common company formation, you heard about the sole trader, you heard about the partnership, you heard about limited liability corporations. And each of these entities, they have a unique set of requirements, laws, and tax implications. So just to reiterate what I said before, the general terms, these are general accounting terms that you may have heard being discussed if you if you, some people have, some people may not, right? So there are cash flow. We talk about what is a business. We talk about an accounting period. Now, from the general terms, we're moving on to the balance sheet terms. And I know some of you may be wondering, what is a balance sheet? Now, a balance sheet, it tells you the company's financial strength at a specific point in time. So there are some companies that may have an accounting period that spans January to December. There are some companies that have an accounting period that spans March to April. And that would be, so at the end of March, or at the end of March, or at the end of December, they will present a balance sheet. And balance sheet, it doesn't have to only be presented at the year end. You can prepare a balance sheet at any time during the accounting period, right? It tells you a company's financial strength at a specific point in time. And the formula is assets equal liabilities plus equity. And I will tell you what an asset is. So we have general accounting terms, we have balance sheet terms, and remember that the balance sheet, it tells you what the financial strength of a company is. It tells you what is the asset, it tells you what is the liability, or what are the liabilities and what are the equities. And assets now, assets are what you own. In the simplest language that I can put it, assets are what you own, right? This includes things like cash. This includes things like accounts receivable, meaning people who owe you money. This includes things like inventory or stock. And this includes things like fixed assets. So if you own a building, or if you own a motor vehicle, or even if you own a desk, that could also be classified as a form of fixed asset, right? You may own computers, and those are also classified as assets. Now, on a balance sheet, your assets, your total assets, should always equal to your total liabilities plus your equity. I'm going to repeat this after I define liabilities and after I define equity, right? So a balance sheet, you will hear some person say, let me see your balance sheet. On your balance sheet, your total assets, meaning everything that you own, should equal to your total liabilities and your total equity, right? Now, liabilities are what you owe. So assets are what you own and liabilities are what you owe. And these include things like accounts payable. So you may have bought, if you own a hotel, you may have bought juice for the hotel on credit from, say, a Wisynco or a Pepsi. Those will go into what you owe. You may buy them on credit, like maybe 30 days or 60 days credit, right? There is also short-term debt. So you may have a debt with the bank for less than a year. There are also bank loans. There is also GCT or income tax payable based on the type of legal structure you have, right? Now, your equity is how much the company is worth on paper. Remember, I told you on your balance sheet, it shows you the financial strength of a company at a specific point in time, and your assets should always or will always equal to your liabilities plus your equity. So what you own, your assets, will always be equal to what you owe and how much the company is worth. Right, so equity is how much the company is worth on paper, which includes money put into the business, money taken out of the business, and earnings retained in the company. Now, from our balance sheet, we move on to our income statement. And what is an income statement? The income statement tells you whether or not you have made a profit over a period of time. And the formula is revenue minus expenses equal your profit. Right, so it's revenue minus your expenses equal your profit. And that will show you how much you made over a period of time or how much loss you made, because there are some instances in which your expenses are greater than your revenue. And revenue refers to income or sales, and it's also known as what you earn. So revenue, income is what you earn. Your expenses now refers to what you spend, and it can be broken down into cost of goods sold and overhead expenses. Cost of goods sold is directly related to revenue. So it is the money that you spend to make your revenue. So I'll give an example. If you own a hotel, right? You own a hotel and you need to wages for the staff at the hotel. So salary for the staff at the hotel, you use those salaries those that are directly involved to the day-to-day. So like the person that cleaned the hotel rooms, the attendants, those costs incurred, they are what we refer to in accounting as cost of goods sold. So it's basically the cost to sell things, right? The cost to make what you earn. So it can be broken down into cost of goods sold, which are directly related to revenue, or it can be overhead expenses, which is the cost to run the business, but it's not directly related to revenue. For instance, marketing costs, training costs, accounting fees, right? Any legal fees. So let me just quickly further explain our balance sheet terms, right? Now, assets, they're items of value or resources that a business owns, and I would have touched on this earlier. They come in many types and they are different classes. They can be current or short-term, or they can be non-current or long-term. If you say long-term assets, it's the same thing as non-current assets. If you say short-term assets, it's the same thing as current assets, right? And how the business will use that asset will determine if it is a long-term or a short-term, or how long the company will have that asset will determine if it's a short-term or a long-term, right? And when you have short or long-term, current or non-current, they can be further split into broad categories. There is cash and cash equivalents, there is real estate, there is intellectual property, and those are all various classes of assets, right? For short term, we usually look at a period of a year or less. So for instance, your cash and cash equivalents, your cash at bank per se, you expect that you will be spending that more than likely every day. Money coming in, money going out, money coming in, money going out. And that we would classify as short term or current. Now, whereas you may have your real estate, and we do not expect that you will have real estate for 1 year if you're not in the business of buying and selling real estate, right? There are also liabilities. A liability occurs when an individual or business owes money to another person or organization. It can be current or non-current, short or long-term, similar to your assets. And equity now, at a basic level, it describes the amount of money that would remain if a business sold all of its assets and paid off all of its debt. And it therefore defines the stake, that stake in a company, right, collectively held by its owner. So to know how I usually look at equity, I usually look at it and say, if I was supposed to settle everything, what would I have left? Sold all my assets, paid off all the money, what do I have left? And that is how I usually look at equity. Now, there are accounts receivable. Remember, I would have said earlier that accounts receivable is a balance sheet term, and it falls under assets, right? And it tracks the money owed to a business. Sometimes you will hear some person call them debtors, or they call them trade receivables. And in most cases, accounts receivable derives from products or services supplied on credit. So when you sell something on credit to somebody else, that would be booked in your accounting system as accounts receivable, right? Accountants track accounts receivable money as assets because it's people owe you. Now, accounts payable, it tracks money owed to your creditors. So it's what you owe to people, not what people owe you, what you owe to people. And it includes bank loans, any unpaid bills, or any invoices. And sometimes we call them trade payables or creditors. And they belong to a larger class of accounting entries known as liabilities. So that is where, so remember, we would have said the balance sheet is assets equal liabilities plus equity. We will put accounts payable on the liabilities. Income statement terms. This describes the income a business earned by selling its product or services, right? This describes the income a business earns by selling its product or services. And it has to be, when we as accountants say, what is your income? It means what is your money from your main operations, right? So if you own a hotel, we know that persons will be coming, persons will be staying maybe overnight, one night, a week, 2 weeks. So when we ask you, what is your income? We're expecting that is money from your main operations. The main operations would be persons coming to stay, or if you have conferences and persons would pay you to use like the rooms, those would be your income as well. Now you may have interest income. If you're a hotel, we do not expect that interest income is your main source of income. So as accountants, we call that other income. And there are also direct costs, and those are costs directly associated with earning revenue, such as food and beverage costs, bar staff, event insurance, event license. There are also indirect costs, and these are costs that cannot be easily identified with a particular product, department, or service. And then there is net income or net loss. Net income is the excess of your revenue over your expenses. So it's really, you take what your revenue or income is, deduct your expenses, and whatever is left, that is your net profit. There are some instances where your expenses are greater than your income, and you have a net loss. Now, there is also what we call a statement of cash flows, right? And I have an extract here, just a snippet I got from a random company, Phantom Books. Now, a statement of cash flow, or the statement of cash flow terms, there are operating activities. Usually the cash flow is divided into 3 main areas: operating activities, investing activities, and financing activities, right? Operating activities now, these refers to cash collected from sales versus cash paid related to sales. So is a cash inflow or outflow from your regular business operations. And I want to point out here that your statement of cash flow, there are some persons, they will take up a set of financial statements and they may look at your income statement, or they may look at your balance sheet. But there are some persons who look at your cash flow, because your cash flow statement shows how you're using the money that the business makes, right? And there are some investors or some persons that use the financial statement, that this is very, very important to them. They want to say, what did they take the money and do with it? And that is why the statement of cash flows is so important, because it shows cash movements, or it captures cash movements in the business, right? There are operating activities, and I would have told you that it refers to cash collected from sales versus cash paid related to sales. There are also investing activities, and investing activities usually looks at any new equipment purchased or sold, right? And then the last category is financing activities. And financing activities are any activities that finance the operations of the business. So any new debt or any new capital injection. So on this example here, you will see under investing activities, they may purchase equipment, right? They may have received some proceeds from sale of equipment or sale of long-term investments. And for investing activities, for financing activities, which are changes in debt or inflow of capital, they have note payable, they have repurchase of common stock, and they have payment of cash dividends. Now we are finished with our key accounting terms, and we're moving on to our key accounting concepts. And there are at a minimum 7 accounting concepts. I'm not going to go through the 7 here, I just chose the ones that I think you will most likely relate to, right? Now, the first concept that I want to explain is matching. And this is very, very important in accounting, right? It is so important that if it is that matching does not occur, there are some auditors who will not sign off on the financials. In fact, if you outsource your accounting services and you have an issue with them matching, they will tell you that some accountants will actually resign. Right, so now the matching concept, it says that you should record revenue and expenses related to revenue at the same time. The purpose is to let you see any cause and effect relationship between income and purchases. And there's a rule for this. Record expenses related to revenue in the same period as the revenue. So you can't have a business and the accounting year is say January to December, right? And you purchased, say you purchased new machinery or a new computer or a new software, right? Say you purchased those, but you're telling the accountant, no, I don't want to record it this year, I want to record it next year. That is in breach of this fundamental accounting principle, right? If you purchase the software and you're using the software, it is mandatory that you record it in the period in which it was purchased, right? Now, economic entity. Economic entity is one of the most important concepts for small businesses. And it says you should avoid commingling business with your personal funds. And this is key, especially when it comes on to tax time in March. Right? You should avoid commingling business with your personal funds. And the business financial statement should only reflect business transactions. The rule here, don't mix or commingle your personal and your business finances. As I usually recommend to clients, please ensure that your business account is separate from your personal account. Now, going concern. Going concern is a concept that says you should assume that your business is in good financial condition and will remain in operation for the foreseeable future. It allows the company to sometimes defer the recognition of certain expenses into future accounting period. And some people may look at this and say, but how does this hold with the matching concept that you explain if you can defer the recognition of certain expenses? And that is because the accounting standards say that, and it aligns with matching. If you're going to have use of this particular asset, for instance, for 10 years, then you have to spread the expenses over the period that you're going to have the benefit of the asset for. And that is how the recognition of the certain expenses comes in. And you assume that business entity is in good standing and will continue in the foreseeable future. If we take up a set of financial statements and there is nothing to indicate that the business intends to close down, the assumption is that the business is a going concern. Now, the concept of duality. In accounting, every transaction has an equal and corresponding effect. That is, it affects two accounts. Every financial transaction is recorded in two accounts as debits and credits. Now, just to jog your memory, when I was talking about the balance sheet, right, and that formula is assets equal liabilities plus equity, if the concept of duality does not occur, then the balance sheet will not balance. And if your balance sheet does not balance, then it's not a balance sheet, it's a table, right? So the concept of duality is extremely important. And I will not go into much more detail because I don't want to get too complex. And I know that you'll be provided with a booklet after the training, right? Now, what the concept of duality says is that if you buy something, say if you're going to enter something in the accounting system, there is one debit and one credit. Every single transaction that is entered in the accounting system affects 2 accounts or more, but the minimum number that it affects is 2 accounts. So debit, it's the basis of double entry accounting pretty much, right? So when a transaction is classified in the double entry system, debit refers to increase in assets and expenses, while a credit refers to decrease in assets and expenses. And we are finished with our key accounting terms. So we went over some general accounting terms as well as some key accounting concepts, and we looked at various areas on the balance sheet. We looked at assets, we looked at liabilities, and we looked at equity, and we also look at the cash flow terms. Now, let's look at bookkeeping, and we're going to look at basic bookkeeping, right? There is single entry bookkeeping and there is double entry bookkeeping, right? Single entry bookkeeping is a straightforward method where one entry is made for each transaction. They're usually maintained in what we as accountants call cash book. There is also double entry bookkeeping, and this is more robust. It follows the principle that every transaction affects at least 2 accounts, and they are recorded as debits and credits. All right. In this system, the total credits must always equal to the total debits, and when this happens, your books are balanced. And it says that it is more robust because if it is that you record something on only one side, so maybe just the debit side or maybe the credit side, when you're doing your checking off, it will show up as a difference. So it will catch any possible errors. Now, with bookkeeping, transactions are usually recorded using the accrual method of accounting, which requires that revenue is recorded when it is earned. Similarly, expenses are recorded when they are incurred, usually along with the corresponding revenues. And you see this coming out when I explained the matching concept. No, the actual cash does not have to enter or exit for the transaction to be recorded. Because remember, you can make purchases and sales on credit. So even if you make the purchase or sale on credit, you are still expected to enter it in the accounting system. Right? And the recording of the transactions, it begins with the source documents, like any purchase or sales orders, any bills, any invoices. And once you gather these documents, you record the transactions using journals, ledgers, and trial balance. No, I just mentioned journal, but what is a journal? What is a ledger? What is a trial balance? The journal is a book, is what we call a book of original entry. Right, and I have an example here to your right, well, my right. It's a book of original entry, and it is where business chronologically, and that is just a fancy name for a date, record the transactions for the first time. It can either be physical or digital, and most people use digital. There was QuickBooks that was mentioned, there is Wave that was mentioned. I know now there is something called Zoho Books. So it can be physical or digital, and I usually recommend digital just for storage purposes, and as the business grows and expands, you will have less and less space to keep these things anyway. Now the ledger, so here with the journal, there is, for instance, this was a purchase of office supplies worth $4,000. They debited the office supplies account and they credited cash. So they were reducing the cash because they used the money, and they debited office supplies expense account. Now, the ledger is a book or a compilation of accounts, right? After entering the transactions in a journal, they are classified into separate accounts and then transferred into the ledger, right? So it's a book or a compilation of accounts. So let's use a cash ledger, for example. So all of these entries for cash, when they're posted, they're compiled into the cash ledger. We usually call it a GL. All of the purchases, all of office supplies, When after they're entered in the journal, they're accumulated into what we call the ledger. And so when an accountant come and asks, let me see your office supplies schedule, for instance, it shows all the purchases of office supplies through the year that ties into your trial balance, and your trial balance is produced from the compiled and summarized ledger. So at the end of the year, for instance, if your year is January to December, at the end of December 2022, you will have your accounting system or your accountant, if you do outsource services, they will combine all the transactions in all the ledgers, because there may be multiple ledgers depending on the size of the business, and they come up with what they call a trial balance. And the trial balance is like a test to see if your book are balanced. It lists the accounts exactly in the following order: assets, liabilities, equity, income, and expenses, with the ending accounting balance. And it says that it is like a test because there are some accounts at the end of your year, it's going to be a debit, and some accounts at the end of the year, it's going to be a credit. And when you sum all the amounts on your trial balance, when you sum all the debits, when you sum all the credits, they should be equal to the same thing. When you put it in one line in an Excel, so when you put it in one column, in an Excel, all debits and all the credits, when you put it in one column in Excel, it should tie to 0. And if it doesn't add to 0, it means that something is wrong when you put it in one column. There are some persons who have it in 2 columns, so you may have cash, fixed assets, expenses, whatever those are, the total of that, the total debits, the total credits should be equal to the same thing. And when you put it in one column in Excel, it should be 0. And if it is not 0, something is wrong and you have to revisit something. Here it is. So I'm showing here, these are all the amounts that would have been entered in the ledgers. There's the interest receivable, there is supplies, there is salaries expense. So they take all of these entries and then the totals. So for instance, the total for interest receivable is 140, it goes here. And this is your trial balance. The total for supplies was 400, at the end when they total the ledger, and it goes here. This is the balance. And you can see where at the total here, the total debit on your trial balance has to be equal to your total credit. And if it does not equal, something is wrong. All right, now, let us look at the flow of transactions in your accounting system, in a typical accounting system, right? It starts with the transaction occurring. So say you go and you buy a motor vehicle, right? There is a purchase order, receipts, and other source document. There are some businesses, I guess for the smaller businesses, there wouldn't be like a purchase order, because usually purchase orders, if it's a one-man business, it is likely that you won't have a purchase order, but you'll have some receipts, some invoice, something to show that you purchased a motor car, right? And then it is recorded in a journal. And then after it is recorded in a journal, which I showed you 2 slides ago, they are posted in the individual accounts, and then the trial balance is prepared, which I just showed you. Now, from the trial balance, we'll prepare the financial statements. Without the trial balance, you cannot prepare the financial statements, right? Because the financial statements, they are prepared with account balances, which comprises the balance sheet, the income statement, and the cash flow, and the statement of changes in equity along with any notes. So if there is no trial balance, you can't prepare these financial statements. And in a typical accounting system, this is how the transactions pass through. Then you come to the end after the financial statements. And then after this year is finished, because your company is a going concern, you start the cycle next year again. Now let us summarize everything that we have learned. There's something else coming in the Q&A. Okay, now let us summarize what we have learned so far. Or the basic bookkeeping. Let us summarize everything. There is the income statement, which asks, are you profitable? Is there more revenue than expenses? There is the balance sheet, which asks, are you healthy? And then there is a statement of cash flow which asks, where is the cash going? All right, where is the cash going? Now we're moving on to the final section of our presentation, which is maintaining proper records, right? Now, let's look at some characteristics of a good accounting system. Any accounting system at all, Zoho, QuickBooks, even the most expensive ones, these are characteristics of every good accounting system. In every accounting system, information has to be reliable. It has to be relevant and it has to be easy to understand, right? When we say reliable, we mean that it needs to be error-free. And if you are second guessing what you get from the accounting system, then that's a problem. But we know it's a system that is man-made, so it's garbage in, garbage out. If the wrong thing was entered, you're going to get the wrong information, right? Before you blame the system, make sure that everything was set up correctly, as the system can only work with the information that it is fed. So it's garbage in, garbage out. Proper information goes in or correct information goes in, then you get a correct or error-free output. Now, information from the accounting system has to be relevant. It is relevant if it influences the business decision. For an accounting system to provide a relevant information, it must be available on time, and it must have a level of detail that is significant enough to show trends, to show any comparison, right? Now, if I have an accounting system and I am meeting with my lenders per se, so I need to pull up, I'm meeting with my lenders tomorrow, so I need to ensure that I pull up some financials now, so that if they ask me about my financial strength, if they're asking me what I'm doing with the money that I make on a day-to-day basis, and I can't just go in and click a button and that information comes up, then something is wrong, right? If I need to know what are all the persons that owe me, so what are all my receivable balance, what are all my due from, who do I have money due from, right? And how much money do they owe me? So if I have 10 persons that owe me money, how much money do they owe me? How long have they owed me these monies? An accounting system should be able to give you that at the click of a button, right? Now, information from a good accounting system should also be easy to understand. The more guesswork involved in an accounting system, the more prone a company is to error. If the accounting system is user-friendly and easy to understand, the more change the accounting system has of being implemented to its full capacity, right? Now, what I usually tell persons is that, or what I usually tell people is that if you learn how to use one accounting system, you will learn to use quite a lot of accounting systems, because though the interfaces may be different based on the accounting system, what they do should be the same. So if there is one where you're like, I don't understand this at all, this looks extremely different from what I'm used to, then we may want to look a bit further on that. All right, so any good accounting system, it has to give you reliable information, it has to give you relevant information, and it should be easy to understand. Also, the information should be comparable that you get from this accounting system. So a great accounting system has easy access to reports that are comparable across business units and periods, right? So meaning, what if your hotel is now big enough, if you have a hotel, or if you have like a Airbnb, like you have a couple of Airbnbs per se, right? What if it is that what if you have had it for 3 years, 5 years, 10 years? If it is that the accounting system can't give you information at least for last year and this year, then something is wrong, right? Because you have to have these comparable information, because they influence the decisions that you make. And that is why it is so important to ensure that you get an accounting system that is applicable to your business. If you see that the accounting system that you have, it's good, but you can't understand it, you don't know how to pull the information from it, and it is always like a pain, you probably need to revisit it, right? It may not be the best accounting system for your business. Now, a good accounting system, it should be accessible. When running your business, it is essential that you're able to quickly and efficiently access data to troubleshoot and map out future plans for not only efficiency, but also success. And lastly, usability. Employees and managers need to be able to use the accounting system with minimal effort and a small learning curve. An otherwise good system that is counterintuitive to your accounting needs can hinder your productivity, right? Remember, if it is that the accounting system that you have, you don't know how to use it, or because I mean we learn every day, so even if you don't know how to use it, you should be able to get some sort of training. And if it is that you realize this is just not working, you may even have to think of outsourcing it or getting somebody who is a dedicated accountant, or somebody who's a dedicated bookkeeper who understands these things, if this accounting is not a core function of the business, right? Now, let's look at keeping proper records. And this is, our slides are winding up very nicely. Now, let's look at keeping proper records. For tax purposes mainly, and the tax specialist, Anaki, went before me, for when you have proper records, it shortens the length of time to do a tax audit. And some persons may be on here and they've never been subjected to a tax audit, but a tax audit is very rigorous. It's very rigorous, and sometimes you can feel as if they're digging up every single thing. And that is why you need to have these records on hand from the good accounting system to provide to them. All right, you can easily identify tax savings when everything is accumulated in the ledger and the tax specialist comes in and say, give me the schedule for office supplies, give me the schedule for your fixed assets, give me the schedule for maybe salaries. Maybe they can even find some tax savings for you. And it verifies business expenses for tax audit purposes. I know one number one question that a tax specialist asks at tax filing time, when you show them your expenses, they always want to know, is this directly related to the operation of the business? If you have proper records, you can show them that, yes, here it is, and this is what I used it in the business to do. Right? So if you have like a consulting firm, so say for instance, I do accounting consultancy, I at a minimum need a laptop, at a minimum I need some sort of training, meaning maybe training on how to train people. Maybe I need to be keeping up with the accounting standards so that as changes happen, I need to be abreast of those. So things like that would be directly related to my business. If I have a consultancy business, I would need like a printer because maybe I have to sign stuff. So I would need to print to sign stuff. So, and I can show the tax auditor that here, this is a printer that I use in a business for these things. Now, they also provide an accurate picture of your business operations. And this is so important because I have now learned that the tax persons from TAJ, if your business has a page on Instagram or Facebook, they sometimes go on it and they peruse it and they use that to make an estimate of what your income should be. Now, if they come in and say, we estimated that you should have 10 million worth of income, and you say to them, I wish that's what I had. I don't have that amount of income, but if you don't have proper records to show them that this is actually what you have, they will work on what they have estimated based on review of the business pages on social media. And so it is important that you keep your accounting records in a safe place and in a proper way. And it also helps you to easily obtain information about the financial position of the business. Other purposes, it makes it quicker to prepare year-end accounts, and it helps you to identify the strengths and weaknesses in your business. And it also makes it so much easier to get a loan and to sell your business. When you go into the bank, they're always going to ask you, where are the accounts? Have they been audited? And if you have these at hand to provide to them, so easy. Makes your life so much easier. Now, in conclusion, the word accounting comes from the word accountability. If you are going to be rich, you need to be accountable for your money. And even if you're not going to be rich, it's just a good practice to have, to be accountable for your money. Now, this is where my presentation ends. I don't know if there are any questions. Let me stop sharing.
Thank you very much, Priscilla. That was really helpful and practical. There is just one question, actually. I know I'm conscious that we're short of time, so there is one question though. Can you just mention the other 3 accounting concepts? That's the question in the chat.
Okay.
I'm not sure what those are referring to, but you hopefully will.
That's fine. So the accounting concepts she's referring to when I spoke about matching and going concern and
Sure.
Yeah, so the key accounting concept, there is the dual aspect, the duality, which I spoke about. There is the cost concept, there is a business entity concepts, there is a money measurement concept, going concern. Sorry. So let's go over them. There is matching, there is duality, there is, I'm just making sure that I tell you, I have them noted here. There is the consistency. So consistency means you have to record the same transactions in the same manner over time. So if you have something that, if you bought a pen, you can't say, oh, this year it's a fixed asset, but next year is an expense because my income statement can take it now. No, if a pen is an expense, a pen is an expense. You can't change it to please how you want your books to look. Right? We spoke about going concern, objectivity. Now, your accounts in general should be objective. So somebody should be able to look at it from the outside, and they should be able to come up with the same presumptions, or they are supposed to come up with the same assumptions. And even though there are assumptions, because it is objective, and because you have your proper records, and because you're employing the same accounting principles year after year after year, then it should be objective. There is also the principle of conservation, and that usually ties in with asset, because there are sometimes we have some accruals, what we call accruals, and you don't want to over recognize those amounts, but you also don't want to under recognize in some instances. So usually for payables or liabilities, we always say recognize. Sometimes it is best to be extremely conservative with those, or to overestimate depending on what the situation is, because you don't want, when the reality comes in, you're left with, oh, I really didn't see this coming, right? So yeah, I think I covered the 7.
Great, thank you.
You're welcome.
And then there's just one more question that's just come in. So as a startup, money taken out of pocket or from personal accounts to use in the business, how would you enter that in the books? So if you're a startup business and you're taking your own money essentially to start the business, I think is the question. How would you enter that?
Yeah, so usually when you take out your own money to start your business, we book that as what we call share capital. So that is equity that you have in the business, right? All those monies that you have injected in your own business, your personal money, that's what we call share capital, and it goes towards equity. When you take out money out of the business for your personal use, in accounting, we call that drawings, and that is a reduction of equity, right? So yes, there is something for that in accounting.
Okay, great. And another question that's just come in as well. So my company main accounts at the commercial bank don't have any card to withdraw cash. And my constant issue is that I need cash without going into the branch. I often transfer cash to my personal account, which I see as a big burden, but often it's the only way to have cash for an early start the next day. Is there any solution or best practice for how to account for that in my books?
Well, all those monies that you take out when you transfer it from the business account, because you don't have a card, and I hope it's not the bank giving you a hard time to get the card. You probably just don't have the time. all those transfers into your personal account to buy something, if you can prove that those transfers to your personal account were for legitimate business expenses because your accounting records are proper and you have all your invoices, all your receipts, and you can prove that to the accountant, I mean, that shouldn't be an issue. And the truth is, if you don't have a card, I don't know of an easier way. But for presentation purposes, if you have the proof, like the receipts that you would have received from these vendors to show that these were for legitimate business expenses, that should not cause an issue at your year end when it comes on to preparing your financial statements.
Great, thank you. That's really helpful, Priscilla. Thank you. So yeah, there's the same person's just commented to say there's none that can be attached to it, not at NCB or Sagicor. I'm setting up accounts in another bank because of that. And thank you for answering the question. And then one more, we'll finish after this one, I think. You mentioned drawings, however, aren't you taxed for these drawings even though you had injected capital? I think that might be related to the previous question as well, or the one before that.
It depends. It depends actually. For limited liability companies, and Anaki, as a tax specialist, she would know more on this, but for limited liabilities, those withdrawals, you are taxed for limited liability companies. So if your company is registered as that, then you are taxed. But if you're registered as a sole trader, you're not taxed for it, I believe. And Anaki can correct me if I'm wrong. If she is, so if it's a limited liability company, you will definitely be taxed for it. But if you're registered as a sole trader, you won't be.
Great. Okay, thank you. And final question, one's just popped up. Is petty cash usually seen in the books?
It is. There are a number of companies actually that have a whole ledger account called petty cash. And in that ledger account, you see all the petty cash transactions there. So there are some persons that actually have a petty cash line. And remember, you need those petty cash receipts as well to enter in the books, so that your expenses can be captured. So though it is petty cash and it usually is a small amount, those receipts are very important. And yes, there is sometimes a ledger for it. There is sometimes a line in the cash account called petty cash, but there are some persons that have a whole ledger that they enter these things in so that they can track them.
Okay, great. And there is just a follow-up question, I think, on the previous one. So the business paying back the loan, I think that's referring to the drawings. So somebody putting cash into the business in the beginning, what about the business effectively treating that as a loan and paying it back? Presumably that's then recorded in the accounts as well, or in the bookkeeping.
Yes, so if it is that it's a business, if you are treating it as a loan in the business, what you would do is actually enter it as a loan. So you could say, okay, this is a loan I'm giving to the business, and the business is recorded as a credit to your liability, which is loan, and as a debit to the cash. And I hope that because you want some money back from your business, you'd be charging the business interest on it, and you record that you should be getting your interest income as well as those payments, and it would eliminate the cash issue because it's a loan. It would eliminate the cash issue, the tax issue, sorry.
Great.
Because yeah,
that makes sense. Thank you. That's great. I think that's all the questions that came up. That's brilliant. Thank you ever so much, Priscilla. I'm just going to hand over to Coral just to highlight the next session next week. I know that we packed a lot in today, so thank you ever so much. Thank you for staying, everybody, and for the further questions. It's been great. I know that we effectively had 2 sessions in one really today, so I'm really grateful for everyone for your time, and particularly to Anna-Kay and Priscilla. I'll just hand over to Coral to highlight the next webinar and a final poll. Thank you.
Great. Thank you, Rebecca. Thanks again, Anna-Kay and Priscilla, and thanks everyone for joining today. We really hope that you found the sessions today educational and hopefully informative as well. So in the coming days, we'll be sending you an email with a link to the manual and the toolkit that Anna-Kay and Priscilla mentioned, and those are related to today's topic. So that should be able to help you with some additional information and resources to give you some more details on these topics. Join us again next week, please, same time and same place for the session on how to write a business plan. Next week, you're going to learn some practical tips on writing a business plan and why it is essential to your business's success. So I know some of you probably already have a business plan. Even if you do, I think it's going to be worth participating, because that session is going to give you a really different perspective, and it is going to help you to tailor your plan to your business values and so on. So really very practical.
Thank you, Priscilla and Anna Kay. That was great.